Hey there, homeowners. In today's video, we're going to touch on a topic that's on many minds, and that's the difference between a HELOC and a HELOAN. In this video, I'm going to break down the difference between the two, even share with you a scenario in terms of what the payments would look like based on your credit scores and how much you draw, and why people are turning to this as the go-to solution in our current market. So let's dive right in. First thing is, let's go ahead and identify what a HELOC stands for. It's short for Home Equity Line of Credit, right? So think of it as a credit card on the equity of your home. It is secured in the form of a second lien, so we would not touch your first mortgage interest rate. And it is a credit limit, none different than, say, getting approved for a credit card, right? You would borrow as much as you need and pay it off as you go. You do have a specific draw period, depending on the banks that you go through. I've seen it where they cap it at the third year. So, for example, you get approved for the loan today. There is a minimum draw required. It can be anywhere from 50% of the loan that you've been approved, or a minimum loan size, say, of $50,000. Now, that can vary. So what ends up happening is, let's say you're consolidating debt. You may be renovating your home, adding a pool. You draw as much as you need at the time. Let's say you get approved for $100,000, but you only need $50,000. You would only pay on the $50,000 that you drew, okay? So that's the difference between a HELOC in terms of it being a line of credit. Now, on the flip side, with the HELOAN, it's short for Home Equity Loan. And instead of drawing a certain amount, you actually will get the full loan size approved in a lump sum. So if you got approved for $150,000 as the second lien, you would get that all in at once, and it would be treated as a fixed loan. Let's look at it as a first mortgage, maybe even a car loan, right? You actually have a dedicated term that you would pay that back, and it's typically on a fixed interest rate. Now, why are these loan options so popular? Well, this is why. Everyone's first mortgage interest rates, for the most part, is super low. That's if you purchase during COVID, refinance during that period, you're likely to be in the 2s or 3% interest rate. However, this market that we're in with higher interest rates, purchase prices being higher, it has a lot of homeowners on edge thinking that, okay, do I tap into my equity to go ahead and purchase new property, invest in more doors? Do they go ahead and take that money and renovate the current home that they live in so that they can live in the home longer? Perhaps do they tap into that money and consolidate debt, pay for a graduation, a wedding, what have you? So keep in mind that taking out a HELOC or a HELOAN does not impact the interest rates on your mortgage, okay? What this does is it does allow for you to give yourself that flexibility to be able to let your money work for you. And what I mean by that is, if you have equity in your home, the only way that you will be able to technically tap into it is if you either sell your house or you refinance to take equity out. And in most cases, because I work with a lot of investors, that's the route that a lot of people are taking. Maybe they bought a home and they are doing a fix and flip. They ran out of money. Perhaps they have equity and they're looking to build or complete a business project and they want to tap into their equity. These are all viable reasons why people would take advantage of this type of product, so that way they can fund that acquisition, that next project, or what have you. So as homeowners are anxiously really waiting the market out, they are now considering taking this direction, especially since maybe purchasing a new home doesn't make sense. Like, it actually costs a lot more to purchase a new house versus taking out an equity loan to renovate their current, right? So by utilizing this equity, you can make more better strategic financial decisions. And what I'm going to do is actually share with you a scenario that I helped with a recent client of mine located in Colorado, just to cover my basis. If you have credit scores of 760 and above, and using this example that the home is valued at $650,000, okay? They owe $470,000, and this will then allow them to tap into a combined loan to value of up to 90 to 95%. So depending on if you go HELOC, typically with those credit scores, you can go up to 95%. Now, if you're doing a HELOAN, that's about a 90%. So right now in this scenario, I'm just going to show you what that looks like doing up to 90%. That would mean that we can tap into $115,000 of equity. And how I did that is by taking the math of first mortgage balance. You always have to factor that in, hence the combined loan to value. So if you owe $470,000, in this case on your first mortgage, and you're taking out a loan of $115,000, when you add the two together, that's a $585,000 loan balance, combining your first and second mortgage together. Now, taking that against your market value of $650,000 would bring us to that 90% value, right? So you take 585 divided by the 650 market value is how I got the 90%. Since they are looking to take advantage of the maximum allowed loan limits, this would then entail $115,000 in their pocket. That's before any closing costs and any fees. So let's kind of dive into what those fees and things like that look like. The difference in the interest rates, to be honest with you, whether you're going HELOAN or HELOC, is not much of a difference. The biggest key that I want you to keep in mind is, does it make sense to have a credit line where you can pull from and then you get cut off? Or do you want that whole lump sum amount and be able to pay it off on a fixed rate? Because when you think of credit card, that fluctuates, right? You pull out money, you have to pay it down. Do you really ever see that go down? It's almost like an interest-only payment. Whereas on a car loan, on a mortgage, you see that principal going down. So in this instance, on a primary residence, 90% LTV with credit scores of 760 and above, and their debt to income ratio is just factoring in below 43%. This would make your payment roughly on an interest rate of 10.65, okay, and can range up to 11.25 if you're going HELOC, where your payments would be $1,065 to $1,078. The APR, just to cover myself, is 10.79 to 11.356. Now, I'm not here to quote you, qualify you. This is simply just for the scenario and in this video to give you an idea of where we are today on June 17th. Now, the fees are very minimal. Think about it. If you're paying, call it $2,500 on your first mortgage, and because your interest rates were so little, and you're taking out an additional $115,000 in this case, and you're paying an additional $1,000 a month, does that make sense? Does this $115,000 now fund your next down payment for your second home, your investment property, that essentially maybe can cash flow more than what your payment will be? You're with me? And maybe you're taking this money out for personal reasons, but I am a big advocate of investing, and you will hear me say that a lot, buying doors, buying and holding property. So hopefully this video kind of gives you an idea of what you can anticipate when taking out either a HELOC or a HELOAN. Whatever your financial goals are, I think it's very important to understand your option and making sure that you have a mortgage loan consultant in your corner to be able to run those scenarios with you. I love it that I'm seeing a lot of my repeat clients come back to me just for those reasons. They're ready to buy more doors. They're ready to pick up another property or another business. And I hope to be able to service you in that same capacity. If you haven't already, my name is Candy Katz. Thank you for joining me today in this video. If you liked it, please give it a thumbs up and share with any family or friend that would find this useful. If you haven't already, hit that subscribe button. Thanks so much for dropping by today. I'll see you guys on the next video.